Everyone talks about SCHD and VO, and honestly for good reason. They are solid funds. Over time, they have created real wealth for a lot of investors. But here's the question almost nobody is asking. What if your biggest priority right now is not growth, but income? Because SCHD yields around 3.5% and VO sits closer to 1.5%. Those numbers sound reasonable until you actually try to live off them. Try to cover a real expense, a car payment, a utility bill, a grocery run, with 1.5% of a portfolio, and the math gets uncomfortable very quickly. And here's what I have noticed with a lot of investors once they realize this. They do not necessarily sell SCHD or VO, but they do start questioning whether those funds alone are actually enough, whether growth is the only goal, or whether at some point the portfolio should be producing real cash flow for their real life. In this video, I am breaking down a category of funds most of the financial community barely talks about. Funds yielding more than double what SCHD pays. Funds designed specifically for monthly cash flow, and in some cases, funds that kept paying investors through every major crash, recession, and panic for nearly 3 decades straight. Let us get into it. Before I get to the specific funds, there is something important you need to understand first, because this is the part most investors skip, and it is exactly where people get burned. I call it the siren song pattern. It starts reasonably enough. An investor comes across a fund showing 13, 14, even 16% yield, and in that moment it just makes sense. Why take less when this is right here? So they buy in, the income shows up every month, it feels steady, it feels like they finally found something that just works. Then over time, things shift. The fund announces it is adjusting its distribution. Sounds routine, easy to glance over. Until you look again and realize it is not a small tweak, it is a cut to the income you were depending on. And almost immediately after that, the share price starts drifting lower because the same income that attracted investors is now smaller than expected. What is left is frustration, not because people were careless, but because they were shown a yield number without understanding the structure behind it. So here is the rule before you put a single dollar into any high-yield fund. Understand the structure first, because if you do not, you can mistake steady cash flow for safety, right before reality quietly reminds you what you actually own. Quick question before I get into the funds themselves. Are you currently in the accumulation phase, still building your portfolio? Or are you in or near the distribution phase where you actually need monthly cash flow right now? Drop your answer in the comments below. I will reply to every single one. It takes 5 seconds and it actually changes which fund makes the most sense for your situation. The first fund is the one that honestly caught me off guard when I first looked into it. It is not flashy. It does not promise overnight returns. But the deeper I looked, the more I realized it was built for a completely different purpose than most income investments. The fund is the DNP Select Income Fund. And unlike most income products people buy today, this is not an ETF. It is a closed-end fund. That difference matters more than most investors realize. Here is how it works. ETFs constantly create and redeem shares based on investor demand. Money flows in, new shares are created. Money flows out, shares disappear. Closed-end funds work differently. They launch with a fixed amount of capital, and after that, the shares trade on the open market like a stock. This creates something interesting. The market price can move completely independently from what the portfolio is actually worth. Sometimes the fund trades below its net asset value, meaning you are buying the underlying assets at a discount. Other times, investors bid it up to a premium. Inside DNP, the portfolio is heavily concentrated in utilities and infrastructure, electric companies, gas distribution, water, telecom. Businesses that do not depend on the economy running hot. They depend on people simply living their lives. In 2008, when everything was falling apart, electricity bills were still being paid. In 2020, with full lockdowns, the grid did not pause. You can delay a lot of things in life. Power is not one of them. The second layer is leverage. DNP uses borrowing to amplify returns from a naturally lower-yielding utility portfolio. When interest rates are low, that structure enhances income. When rates rise sharply, as they did in 2022 and 2023, the cost of leverage rises too, and performance gets compressed. You can see that in the fund's multi-year returns, which have at times been modest despite the steady income. And yet through all of it, one thing has stayed completely consistent: the distribution. Since 1997, DNP has paid approximately 6 cents per share every month. Through the dot-com crash, through 2008, through COVID, through rate hike cycles, nearly 28 years of the same monthly payment showing up like clockwork. The current yield sits around 7.3%. Now here is where investors often misread this fund. That payout is maintained under a managed distribution plan, supported by a mix of net investment income, capital gains, and when needed, return of capital. Most investors hear return of capital and get nervous. And if a fund is only paying you back your own money with no underlying earnings, that is a legitimate red flag. But in DNP's case, the bulk is backed by real income. The underlying portfolio keeps generating. The lights have not gone out. There is also something called the drip discount that most people completely miss. When you reinvest your monthly distributions and the fund is trading at a premium to its net asset value, you do not reinvest at the market price. You reinvest at approximately 5% below the market. If DNP is trading at 10.50, you are effectively reinvesting closer to 9.97 every single month. Month after month, that small discount quietly compounds in your favor. It is rare in the closed-end fund world, and it is one of the features that makes DNP distinctive. One caveat, not every brokerage handles this correctly. Some apply it automatically, others do not. It is worth calling your brokerage and asking whether they properly support discounted drip reinvestment for closed-end funds. A small detail that makes a real difference over long periods. DNP is not the only fund income investors look at in this space. And if a 7.3% yield makes you wonder whether you can push it further, PIMCO enters the conversation. The two funds most worth knowing are the PIMCO Corporate and Income Opportunity Fund, ticker PTY, and the PIMCO Dynamic Income Fund, ticker PDI. PTY has often hovered around a 10 to 11% yield. PDI has built a similar reputation for aggressive monthly income. Both are managed by PIMCO, one of the most respected fixed income managers in the world. But the way they generate that income is completely different from DNP. DNP owns utility and infrastructure companies, boring businesses. PTY and PDI are built around credit markets, corporate bonds, mortgage-backed securities, global fixed income assets. That difference matters because utility businesses are slow and defensive. Credit markets are more sensitive. When rates rise fast, when borrowing becomes expensive, or when the economy weakens, bond-focused funds feel that pressure much faster. PIMCO's edge is that they know how to manage that complexity better than almost anyone. Their experience is the reason PTY and PDI have survived. But the trade-off is real. Higher yield comes with more moving parts, more sensitivity to market conditions, and more volatility underneath the surface. Think of DNP as the steady foundation, the part of the portfolio that quietly does its job without needing your attention. PTY and PDI are the higher income layer you add when you want to push the income further while accepting more movement along the way. Many experienced income investors use both. DNP for consistency, PIMCO for income enhancement, each playing a different role. There is one more fund worth mentioning for a slightly different type of investor, the Reeves Utility Income Fund, ticker UTG. The starting yield is lower than DNP, but UTG has a history of actually growing its distribution over time. For younger investors still building, a growing payout can become more powerful long-term than a payout that simply stays flat for 3 decades. The math is genuinely different. If you are building toward income rather than living off it today, UTG deserves a spot in the conversation alongside DNP. Now let us put all of this in honest context against SCHD and VO, because these are not bad investments. They are just built for a different purpose. SCHD at 3.6% yield and VO under 1.5% are telling you one thing: keep building. They are long-term wealth compounding machines. Lower yield up front, stronger long-term growth potential, simpler structures, lower fees, fewer moving parts. VO is probably doing more work per dollar now. But at the distribution stage, when you actually need the monthly check, that calculation changes completely. Goal shifts from growth to cash flow. SCHD's 3.6% and VO's 1.5% start looking very different next to a 7.3% monthly payer that has not missed a payment in 28 years. The real question is not which investment is best. The question is, what do you actually need this investment to do for you right now? At accumulation, VO is probably doing the most work. At distribution, monthly income funds enter the conversation. Combination for those in between. Here is the part I wish someone had explained to me earlier. Most investors spend years measuring their portfolio by one number, the total value. And then at some point something shifts. They stop looking at it like a scoreboard and start looking at it like something that should actually produce cash flow. SCHD and VO are not wrong, but they were built to grow wealth over time, not to send you meaningful monthly cash flow today. DNP Select Income Fund was built for something different. Nearly 28 years of the same monthly payment, utilities and infrastructure that keep generating. PTY and PDI are for the investors who see 7% and think there is room to go further, and understand higher income comes with more volatility. The best income portfolios I have seen do not try to find one perfect fund. They understand what role each holding plays and they build accordingly. Consistency from one layer, income enhancement from another, that is the shift to building a portfolio that pays you the way you want to be paid. Before you go, I want to know one thing from you specifically. Are you team SCHD and VO? Build now, collect later, a trade d'écrit? Or are you already leaning toward monthly income funds because you want the cash flow hitting your account right now? Drop your answer below. If this breakdown was useful, subscribe. More analysis like this every week. Let us build something that actually pays you.